Hey everyone, this is Scott with Luminary Wealth. Welcome to Luminate, a video series where we demystify financial markets and dig into the science of investing based on evidence, not imagination. Over the next couple of episodes, we'll be exploring the value of global diversification in your investment portfolio. I'll share with you a few of the big ideas that has led to our commitment to building global portfolios for investors over the last 19 years. But before we begin, please know that building a well-designed investment portfolio is a complex task, and it really must be done with your unique circumstances in full view, because there is no one-size-fits-all portfolio. So please be mindful of the circumstances as you consider these general ideas that we'll be exploring with you here. So with that in mind, though, let's dig right in. Would you like the chances to improve that your investments will do better than the U.S. stock market over the long term? However, do you feel the chance that that's happening is now slim, especially since the COVID-19 pandemic has suppressed economic growth around the world? Well, I'd like to share with you a few facts that we observed about the global stock market performance during the first quarter of 2020. And I believe they may help you to open your thinking about the benefit of including global stocks in a long-term portfolio. Whatever your source of news, I'd like you to take a moment and think of how dramatically the world has changed during this first quarter of 2020. We've experienced a global self-imposed economic shutdown in just a matter of weeks due to the pandemic, and the speed of this decline must be unrivaled in history. So given that context, here's the question. Which countries or country across the globe would you guess had the best stock market performance for the quarter? Now, I'd like to take a look at this slide with me. So what we're looking at here is two columns, and your left column is developed markets, and there's 23 of them. And on the right column, there is what we call emerging markets, and those are on the left. Now, take a look at who sits atop the column on the right. China. Yeah, the source country of the pandemic that caused the shutdown of the world's economy. China posted an outstanding performance for the first quarter of 2020 relative to all the other countries across the globe, except Denmark. The Chinese stock market almost doubled the performance of the U.S. stock market. China's market index was down by only 10.3%, only to be bested by Denmark that was down about 9.6%, less than a percent difference between the two. Now notice, where was the U.S. during the quarter? They were down here at number 8, about 21% down for the quarter. So you can see that about 7 developed countries outperformed the U.S., as well as 3 emerging market countries. I hope you find this surprising. How could a country so impacted by the virus lead the global stock market performance for the quarter? A second question that is very instructive for investors is this. Who would have recommended increasing allocations to Chinese stocks at the beginning of the quarter, especially if they could have seen what was about to unfold? Now, this is a very important question because it serves as a data point for how accurately professional analysts or stock pickers pick ex ante, that is, before the fact. Which professional analysts were calling to overweight our investment dollars into China and Denmark? See, doing so on January 1 would have doubled our performance for the quarter. Now here's another insight you may find counterintuitive. Sweden, whose public policy guidance has been an outlier in how they've handled the virus, they've avoided lockdowns and opting instead for significant testing and contact tracing and protecting the most vulnerable and allowing the younger, healthier populations to continue to be active and remain productive. And so as a result, they had lower suppression of economic activity than the United States. And yet, they underperformed the United States. So what we think are common sense predictions, no-brainers, about which stocks should do better, that often fails miserably at predicting those that will actually do better. Evidence that we'll explore in later episodes will show that even the best and brightest equity analysts, or stock pickers as we like to call them, forecast winning stocks between only 10 and 20% of the time. Well, I don't know about you, but I'm not willing to place my trust in recommendations that fail 80% of the time. And we'll be looking at a little bit of the empirical evidence that supports those numbers. So I hope this little exercise helps you see what may seem like obviously good investment choices beforehand may turn out, in fact, exactly the opposite of what we expected. I think it showed you how difficult it is for even top professionals to guess the winning stocks, assuming they had knowledge of the future. And so how much more difficult is it to pick winners before you know tomorrow's news? So this is the first principle for you to learn. Write it down. It's really hard to pick tomorrow's winners today. This is true for the best and the brightest professional investors competing against each other every day. And it's true for you. So let me highlight two benefits an investor may receive by holding a globally diversified portfolio over the long term. Number one, spreading investments across global investment opportunities means you'll get the benefit of non-U.S. companies that outperform over time. Take a look at this next slide with me. What you'll see in this slide is the countries and percentages that their country's stock market represents as a percentage of the global stock market. So as you can see, the United States represents 54% of the global stock market, which means that we still have a large 46% of the global stock market outside of the U.S. As I said before, there are many great companies that exist outside of the United States. So why would we want to cut off our opportunities to gain the benefit of return coming from those other great countries outside the United States? I think it behooves us to add them and keep them in our portfolio. Number two, it'll spare you the opportunities lost by wrong predictions that drag on your return. So let me explain the slide. Each of the checkerboards represents a different country. These are developed countries. There are about 25 of them on this chart. And it's organized this way. The very top row gives the country that had the highest return for that year, and they're just ranked ordinally all the way down to the last row that shows the country with the lowest return for the year. As we move left to right, it covers the year by year. So we're starting in the year 2000, and it takes us over to 2019, which is 20 years of data for us to look at. So the first question is, can you see any pattern predictable that would enable you to select tomorrow's winners or next year's winners based on the prior year return? Let's take a look at the United States just by way of an example. I'm going to be circling them each year where they ranked for the year. And as I go through here, I think you can see that there is only one year, right here in 2014, where the United States actually was the highest performing country for the year over this 20-year period. Furthermore, if I just take a random look and just kind of, cut in half the checkerboard, you can see that I've got a number of those United States circles that are in the lower half of the return spectrum for that period of time. So again, it's very difficult to predict tomorrow's winners today, and by staying in the U.S. only, we're cutting off the opportunity for returns that outperform the United States by other countries. So I hope this helps you all see why investing internationally may be something worth considering. Please join me next time when we'll dig a little deeper into how a globally diversified investment portfolio holds up against a US-only portfolio. And please remember to subscribe to our Luminary Wealth YouTube channel. You can also access our content by visiting www.luminarywealth.com. Until then, stay well and stay safe.